Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Excited to be back here today, home studios for today's podcast, right here at the very beginning of September 6th, and about 60 days exactly, I think, from the presidential election coming up here early November. So we got some stuff to talk about here. Definitely some market data affecting markets as we speak here, and kind of a lot to go over. So I'm looking forward to today's discussion. Today will likely be more of a conversation as opposed to a whole bunch of data sharing, although we'll talk a little bit about some of the data that is spurring on the reaction that we're seeing here. So a lot to go over, Ez, but we did have some fun things to talk about too, other than people's interpretation of the data here, which we'll certainly spend some time on. But how about that football game last night, man? NFL is back.
NFL is back. I know that the Joshua Garland household is happier for it, as most people are. Awesome start to the season for my neighborhood, where I live in Louisville. Of course, everybody down here is a big Lamar Jackson fan, so it was awesome having that be the first game of the season. Seeing Lamar, that last touchdown that got called back. If I were the Ravens, I'd be filing a police report on that because that was just a straight up robbery. So.
Yeah, it was an interesting game, fun, exciting, all the things. So it should be a great season. Looking forward to tonight, game in Brazil, which will be cool. And
Oh,
I
I
got
didn't know that. That's awesome.
Yeah, Friday night football, NFL style, down in Brazil. So that'll be fun. Looking forward to that. We got, of course, the fantasy football draft that's already happened for those that participate in that. I got my team set up, so we got players in last night's game and tonight, and certainly on Sunday. So a lot to look forward to from a sports fan perspective. And thank God, because the data that we've talked about regarding the macro economy, jobs, unemployment rate, inflation. We spent 2 years talking about the path of inflation, how that's affecting the markets.
Yeah.
All the earnings announcements, GDP, we've covered it all. And what we spend the most time talking about on this show is controlling two things. Warren Buffett's talked about this his entire lifetime, his entire investing career. You can Google it if you don't believe me. But Buffett talks about two things that individual investors need to control if they have any hope of getting consistent positive returns, let alone being able to outperform something like the S&P 500 index over a consistently long period of time. And those two things, starting with their temperament. Buffett talks about the number one reason why individual investors do not achieve the results that they're looking for consistently over time is because they have no control over their temperament, meaning they have no control over their emotions. Investors obviously are highly emotional. We're talking about things like money. Whatever your beliefs are about money, there's like $30 trillion circulating in the United States economy. That's just here in the United States. It's not even other countries' currencies. There's literally enough money in the United States for everyone in this country to have at least $1 billion. So there is no shortage of money in any way, shape, or form, but we tend to be very emotional when it comes to our money as individual investors. Matter of fact, behavioral finance, you can get a PhD in that specific major at every major university across the country these days. And that study basically just helps explain that individual investors feel losses twice as much as they feel good about making money. So when there's any fear or reasons to be fearful when it comes to your portfolio and your investments, that fear tends to take over is really what that study kind of helps you understand. So how do you get control over those emotions so that you can control the second thing? That is your asset allocation. Buffett talks about asset allocation driving 94% of the variability of the performance in anybody's account. That's also backed up by modern portfolio theory, which is a general way to kind of understand finance 101. But once you get control over your emotions, now you can begin to develop an asset allocation based on how the market has reacted, how other human beings, when we say the market, it's really just a bunch of human beings. And the great news about that is human beings are the most predictable thing on the planet. We haven't really changed all that much in a couple thousand years. And we've studied human beings for so long that I think we can all probably agree that we tend to repeat our behavior. They teach history for a reason, but we tend to repeat a lot of that stuff too, right? So that's what this show is really geared towards, getting you the information that you see in the news, yes, this is what's going on. We're going to talk about the data, but here's what you want to look at from a historical perspective. And this is how human beings have reacted over the course of the next 6, 9, and 12 months. And that's how we control the allocation. Start with controlling the emotions. Once we have that under control, let's look and see what history has to say about how other human beings have behaved in a similar environment. And now we can begin to put probabilities in our favor as investors, saying, under these circumstances, A, B, and C sectors of the S&P 500 tend to do better than everything else by a factor of 50%. You might want to take that historical precedent and allocate accordingly. Now, past performance is not a guarantee of any future results. Investing involves risk, including risk of loss.
Yeah.
But what we're going to be talking about today, and really just having a conversation with the viewers here today, less data focused, more just a conversation about individual investors' emotions. So that's what I want to spend some time on today, Ez, and certainly hope this is helpful for everybody out there that's part of the program. We certainly appreciate your viewership, your questions, and just continue to follow our program here, because we'll continue to deliver this kind of content, which you just simply are not going to hear from the major news outlets. And I don't knock the news outlets. They're doing a great job of providing factual information, but they tend to placate towards the fear side of investors because, again, they understand human emotions, the fact that we feel losses twice as much as we feel good about gains. And that's generally the only headline that you see.
Yeah, I'll knock it. I'll knock them. Scare
Knock 'em.
tactic, media conglomerates, especially this past year, them roughing up the inflation data to make it seem like things are worse than they really are, when most people don't have time to sit down and really dig through the stuff on their own. They just trust the headline news and causing panics and mini sell-offs. Yeah, I'll talk all kinds of trash about mass media headline news.
Yeah. I mean, the fact of the matter is, just a little bit of data just kind of kick off the conversation about where we're at here today. So post Labor Day, the S&P 500 started September with a greater than 2% decline. This is the worst start to the month of September since 2015. And it's the fifth worst start since 1928. Okay. By the way, this is on the back of an S&P 500, just so everybody's very clear on this. There's a lot of fear in the market. That's what that first piece of data is telling you. All right, fifth worst September since 1928. But the S&P 500 has risen 7 of the last 8 months in 2024. That's a strong economy, simply put. So post Labor Day, the S&P 500 started September with a 2% decline, and that's the worst start for the S&P 500 in September since 2015. And by the way, this is the fifth worst start since 1928 in the month of September. Now, obviously a terrible start to the month of September, historically bad, a fifth worst since 1928 as the data just provided us. However, the S&P 500, the stock market, is up 7 of the last 8 months in 2024. That is, without question, a sign of a strong economy. Now, the data that we got here today was updated jobs data. So last month in July, we received, obviously, a monthly jobs report. I'm sorry, in the month of August, we received the July jobs report. So August, we got July's information for jobs. And that data came in at 89,000. And the market was looking for something like 165,000 jobs again. So obviously, there was a huge disappointment from August jobs report data. Now, again, that was based on July, right, the month prior. And we called this out. We called this out at the very beginning of August. The market sold off extremely hard on August 1st, all the way through August 5th lows. And I do believe that August 5th is the low coming into the back half of this year. So I don't think that we'll actually see the S&P fall below the August 5th low. If you got some questions about that, hit me up, 513-630-2664. Or just go to shepherdwm.com and find us on the website. You can send me an email if you have some questions about why we believe that August 5th lows will hold. We won't actually see a bigger decline than that on the back half of 2024. So labor market from August jobs report, did not provide any of the information of how that hurricane in Texas affected the labor market in July. Again, we got that data in early August. Because the jobs data was so disappointing, the market sold off substantially and fear has risen. Matter of fact, there is something called a VIX index. This is a volatility index. It just helps investors understand how fearful the general market participants are. The VIX index spiked to nearly 70. And to put that into perspective, the only time that we've ever seen the VIX spike above 60 in that manner so rapidly were major crises events like the global pandemic of COVID or 2008. We've never seen the VIX index spike that much so quickly under any other circumstance other than the worst things that come to mind as it relates to individual investing. Because of all of that, because of the worst start, the fifth worst start since 1928, even though the S&P 500 is positive 7 of 8 months, investors are so afraid with an election coming up that we don't know the outcome of. So markets in general just do not like uncertainty. Although history would say, regardless of the outcome of the election, the market's going to average about 10%. Again, this is why we spend so much time talking about historical perspective. Individual investors, human beings, have not changed all that much. This is what will give you an edge. If you can control your emotions and look how other human beings have behaved under those stressful circumstances, you can put probabilities in your favor. You might not like the result over the next week or month, in this case, from early August sell-off, the sell-off that we're still seeing now here in early September. You might not like being a market participant over that 30-day stretch of time. And that could last another 30, 60 days because we're 60 days away from the actual election. So that uncertainty of that outcome, being the election, won't be known for a couple more months. So you might be dealing with this fearfulness, this side of every human being that makes you human. You're going to have to deal with that all the way until we get through the November 6th election day. And that doesn't guarantee that things are going to be great after that, but history would say post-election, now that that uncertainty has been removed, as long as there isn't some sort of recessionary, reason to be afraid, markets tend to do great. And that's where I want to kind of go to next is I believe what we're seeing here since the the August jobs report, again, July's data, all the way until now, markets have been focusing more of the path and growth of the U.S. economy as it relates to jobs, more so than it's worried about inflation. Inflation's an afterthought now. Federal Reserve Chairman Waller and Goolsbee, Fed Chairman Powell himself, pretty much every Fed governor has come out and said inflation is no longer going to be the driving force of our rate decisions. It's now going to be focused on the labor market. What do humans do? They start to focus on the labor market. And today's jobs report coming in at 145,000, Street was looking for 165,000. That's about what the pre-pandemic average labor market growth is month over month. It's about 140 to 150,000 jobs. Unemployment, by the way, ticked down from 4.3% to 4.2%. The Fed's job is to have full employment, and they generally define that about 4% unemployment rate, 4 to 4.5. Obviously, we're already there. And they're looking for inflation to track around 2% over a long period of time. They've already come out and said they believe that that is to be the case over the next couple of quarters here. They don't have to wait until we get to 2% before they start cutting rates. And that's what the dilemma is between the individual investors' emotions and what the Federal Reserve is actually going to do. Are they going to cut by 25 basis points? Are they going to continue to cut by 25 basis points like we believe here over the next 3 meetings, September, November, and December? So 75 basis points worth of cuts before the end of the year. They'll continue that into 2025, ultimately bringing down the federal funds rate from 5.5, where we're at today, 5.25 to 5.5. They're very likely somewhere around 3.5. Okay, that's where we're going. The market understands that's where we're going. It also understands that GDP is above 2%, which is the long-term average for growth here in the U.S. economy. We just got off of another excellent earnings report, another excellent earnings season for all or not all companies, but the majority of companies, over 80% of the S&P 500 beating earnings estimates. That did not mean that their stock price went up afterwards. NVIDIA being the best example of that. Over 100% revenue growth year over year. I think it was like 120 something percent. There isn't another company on the S&P that can come close to that. Yet the stock price fell, I think it was 10% after their earnings. So you're dealing with a group of investors that have no idea what the outcome of the election is going to be, although it doesn't matter in the long scheme of things. There will be sectors, depending on who the president is, that will benefit more than others. That is a no-brainer, duh kind of statement. But the market as a whole, regardless of the outcome of the election, averages about 10%. Why individual investors don't focus on the historical precedents where we have hundreds of years worth of data is beyond me. That gives you the competitive advantage. That's how I'm able to stay invested during all these turbulent times, because we've been looking at the data over the last month. Inflation's coming down. The Fed is cutting rates. The Fed raised rates to contain inflation, and they knew that was going to cause an increase in the unemployment rate, but we have not yet breached that 4.5% unemployment rate. Earnings have been fantastic. GDP is above 2%. There is not one piece of data that anybody can point to me that would be a reason for this kind of market reaction. This reaction is really investors thinking that recession is much more likely than economic growth continuing into 2025. I don't know how you can look at all of this data, again, all the things I just talked about, and come up with, yes, that equals recession. The simple thing that you could look at, like the Fed is talking about here, is the jobs data. Well, again, we're right around pre-pandemic average month-over-month employment. If all of a sudden General Motors, Tesla, Microsoft, Amazon, Apple, Google, pick your favorite large S&P 500 company, if those companies start to lay off their workforce in a big way, that is your indication of recession. Why? Because 70% of the U.S. economy is consumers consuming. The only way to consume is if you have a job. And if you continue to consume without a job, without a way to pay for that, of course, your credit card debt goes up. Eventually, you're going to file for bankruptcy. And that does, in fact, equal recession, right? That's not what we're seeing. And the data is not telling us that. Yes, we had one bad jobs report, but that had everything to do with a hurricane that affected 1.3 million Texans and their businesses for over 2 weeks. None of that is being discussed in any of the news outlets, not one. CNBC, Fox News, CNN, not one is talking about that at all. They're just saying, hey, this was the jobs number. That is factual. They can say that. But then they're going to talk about, oh, man, shit, that was off by like 100,000 jobs.
Right.
Must be going into a recession, right? This is why we do the program. This is why I love my job. This is not fun for me to sit here and, watch our portfolio go from beating the S&P 500 to trailing all of a sudden within 1 month. The reason why we're not shaken in our confidence is because we've actually gotten the data right. I didn't know that the hurricane in Texas was going to affect the jobs report by that much, right? But what we did do is actually look at the BLS's data, the government's data for jobs, and say, oh yeah, it's very likely that about 75,000 Texans probably would have been added to that monthly jobs report had we not been through that. And we expect the next labor report, which is what we got today, to reflect it, and it did. Right? We didn't get to 165,000 jobs, but we weren't off 100,000 jobs either. I actually expected a much better, stronger market reaction to the upside. But really what all you're hearing about is that we missed jobs. That's all you're seeing, in the news today. That's the only thing that anybody wants to talk about. And it's the only headline that I'm sitting here in my home office right now where we're doing this podcast, and I'm looking at a television. And again, every major average is down about 1%. NASDAQ is down almost 2.5%. And it is a whole bunch of fear. The VIX is up above 20 yet again. And I just do not come to the same conclusion when I look at all this information and come up with recession. It actually happens a little less than 20% of the time. If you just want to wake up on January 1st as a market participant and say, okay, am I going to invest this year or not? There's about a 77% chance the market is going to be higher than what it was on January 1st. All right. That other 23%, yeah, that would be the opportunity for a recession to happen. So better than 3 out of 4 times, markets are higher, and a little less than 1 out of 4 times, markets actually lower. It could be due to recession. So I don't get it, but the data has been correct. We've called it correctly this entire volatile month that we've been going through. And what we believe to have happened here at Shepherd Wealth Management for our clients is the market has a cold, right? The market has a cold, and mostly it's driven for fear of recession due to deterioration in the jobs market. Market just needs a little bit of medicine. That medicine comes in the form of interest rate cuts. Okay. So what you're likely to see here is the Fed to cut rates 50 basis points, 25. It's very likely to be 25, and it doesn't matter, right? The market might anticipate a 50 basis point cut as the Fed's being fearful that jobs are actually decelerating faster than the market believes. So that's a reason to be extra fearful again, even though you got the 50 basis point cut that I think the market would really like to see. If they stick with 25 basis point cuts, the information that you're likely going to see on CNBC and Fox News and everywhere else is the Fed's waiting too long to cut rates fast enough. They're still behind the curve. So either way, you're going to probably deal with some extreme emotions between now and November 7th. But once we get to November 7th and that outcome of the election is known, whatever that outcome is, what do you have to look forward to as an individual investor? Well, we know who the president is. Well, we also know that they can't do a damn thing about their policies for at least a couple more months, right? So that's out. You don't have to worry about that. We know that the Fed's cutting rates, and they're likely going to continue to cut rates between now and the end of the year and into next year. You're probably going to hear that from Jerome Powell here on the 18th of September. We're also going to look at the unemployment rate probably still hanging out around 4%. You're going to see GDP being above 2%. You're going to go into a fourth quarter earnings season, October through December, which historically, regardless election year or not, is a great quarter for individual investors to participate in. Got holiday season, a lot of spending happening, essentially. A lot of overtime hours are being put in. A lot of GDP going up. That's what you're going to see. You're just going to have to deal with everybody else's assessment of the market's cold, right? And their reaction to it. They want to start cutting off body limbs, right? That's really what the market's saying right now is like, we got to start cutting stuff off before this cancer hits, more important parts of the market here, right? That's the kind of feeling that I think is true when you actually watch the markets as closely as we do on a daily basis. Wouldn't recommend that for the average person out there, because we take that information, that reaction that we see on a day in and day out basis, we compare it to what history has to say, and now we're putting probabilities in our favor. So we are fully invested right now. So what do you do? What do you do when you're fully invested and the market's trying to assess how we're going to deal with this perceived cold, being that the jobs market is being perceived as deteriorating? It might be slowing. I think deteriorating is a very strong word. They solved that through rate cuts. This is what the Fed's job is. Why we have to deal with this as individual investors has everything to do with the lack of people being able or willing to spend time looking into the details of all the data and how market history has played itself out. But that's exactly what we've been charged to do here for our customers. So when it comes to staying invested, if you are fully invested, you have to ride this out. I don't like it any more than you do. I don't want to see the portfolio go down between now and the next 60 days. I'm not saying it's going to go in a straight line down. That's not going to happen. You're going to see it go up and down. You're going to see it do some really great days of 2+%. You're going to see some terrible days like what we're seeing here today. You're going to have to deal with all of that, and you're just going to have to write it out. Now, if you have some positions in the account that are more defensive in nature, they're probably doing okay at the moment, whereas your tech holdings, your small cap holdings, probably taking on the chin a little bit more. You could rebalance a little bit. That could be an opportunity for you to take some of those more defensive investments within the portfolio, take some of those dollars away from that, and start to slowly dollar cost average into your favorite companies. If you do not expect a recession, this is an excellent buying opportunity. I think this is nothing but a buying opportunity. Unfortunately for our customers, is we've already done the rebalance. We took away from tech post July 4th and started to diversify across more sectors within the S&P. We traditionally try to focus on a couple of core sectors, really overweight them, That's what led to the significant outperformance we've been able to achieve for our customers over time that they're very excited about. Um, but right now, with all this volatility, diversification makes some sense. So that's what we have done for our customers being fully invested. If you've been sitting this out, if you're one of those folks like there's $6 trillion still sitting in cash and money markets across the United States, which is again staggering. It's the most cash we've seen since 2008, and this is nothing even close to the 2008 type of environment. Not even it's uncomparable. Like the only thing you can compare 2008 to was 1929 in this country. But that's where we're at, $6 trillion sitting in cash. And if you're one of those investors, I encourage you not to put all of that cash to work in one day, but look at the history of how human beings have behaved during a rate cutting cycle while unemployment is still below 4.5%. Look for those historical data points and slowly dollar cost average on days like today, where the market's selling off, a week like today, shoot, a month like what we've just seen. This is giving you every opportunity to pick up your favorite sectors or companies within your favorite sectors at a much lower price than what you would have paid for it on July 31st. July 31st, we were kind of at peak performance, or right about July 31st. And right as soon as we got into August, and every day since then, it feels like the market is lower and lower and lower. This is not going to zero. Okay. If you have an index like the small cap index or the S&P 500 index or the NASDAQ index, and you're getting whipsawed around every day, it's an index. It's not going to zero. Okay. There are 500 companies that make up the S&P 500. They're not going to zero. Just because your candidate didn't win the election, it's going to be okay. Okay. The NASDAQ, same thing. It's an index. It's not going to zero. AI is all of a sudden, not in vogue over the last couple of weeks. Although, the earnings would suggest very much in vogue. I just gave you guys a little bit of piece of NVIDIA's earnings. You can go look at it yourself. Market is still selling NVIDIA. It was at about $140 a share. It's hanging out around $100 right now. If you're sitting cash, I'm not telling you go put it in all in one company or all in one sector or do it all in one day. But look at what human beings have done, how they've responded post-election, which is getting closer and closer, how they've responded when the Fed is engaged, meaning they're cutting interest rates. What sectors did the best? Now you have control over your emotions. Now you know what the probabilities are looking out another 3, 6, 9, 12 months. Instead of focusing on the pain that you're seeing today, do something about it. You can either complain about it or you can take some action to do something about it. And this is how we take action. And right now, that action is not taking action. That's okay. As long as you have an understanding of how human beings have behaved under the environment that we're in right now and about to go through, you're going to be just fine. You're going to be laughing about this month, 2 months, whatever, maybe 3 months of volatility that we're dealing here right now. You'll look back, you'll laugh and say, gosh, I cannot believe I got so close, just thrown in the towel to giving up completely about ever being able to make any money when it comes to investing in the stock market. If that is you, that is what we are here for. That is exactly what I am charged to do every day for clients. Yeah, it's making money, but the majority of the time, it's just helping other human beings understand, good or bad, why they are where they are from their performance and why we have positioned things the way that we have, even though it might be against whatever the headline news is. I can tell you from dealing with these customers, for over 3.5 years at Shepherd Wealth Management, over a decade between my time at much larger companies like a Fidelity and TD Ameritrade. This is the time every 4 years where investors are the most sensitive to every little data point. I'm not even sure that if we got 165,000 jobs or greater in the jobs report we got today, that we wouldn't see something similar to like what we're seeing here today. It is painful. It's not fun to sit through, but I encourage you. This is not the way that the market is going to be forever and always. This election will pass. But the bottom line fundamentals and historical precedents right now are in your favor. Whether you are fully invested or you're sitting on cash, there is something for you to do, and it might be doing nothing. If you've done the rebalance like we did not that long ago, we are positioned for rate cuts, for the U.S. economy to continue to grow from a GDP perspective, for corporate profits to continue to grow and stay strong, and for a historically great Q4, specifically post an election. It's all lining up in your favor. You just have to have the discipline to understand I am a human being. I am emotional. I need to get control over those things. How can I do that? I'm going to look and see how the market, meaning other human beings, have behaved under these circumstances. And if you look at it through that lens, I promise you, you'll feel better because you'll understand where your risk is, where the probabilities for growth are, and you make those decisions. And now you can sleep at night because it's not your gut feeling driving the ship here. This is actual data helping you stay calm and rational, stay invested, or if you're not, how to get invested, because everybody would agree that over a long enough period of time, the biggest way to drive wealth is certainly through the stock market. But if you treat the stock market like a casino, meaning that you're in and out, you're extremely emotional, you're all about the market one day, you hate everything about it the next day. If that's you and you treat the market like a casino, you're going to get casino-like returns.
Yep.
You're going to blow it out of the water for a second. You're going to think that you're the next Warren Buffett. Your emotions are going to be running rampantly. That greed part of every human being also is still there. And you're going to get crushed on a day like today if that's the way that you're treating your portfolio, your investments in the marketplace. So understand that the market can have colds. We're dealing with it right now. The medicine is coming in the form of interest rate cuts. This was told to you by the Fed. Why they started to raise rates to begin with was to control inflation. They said there will be pain in the labor market because of interest rates going up. The reverse is true on the way down. The best part about that interest rate increase, as bad as it sucked, and you can go back and look at all of our podcasts from 2022 January all the way through last year, and you'll hear us talking about inflation, the Fed has to raise rates, et cetera, and the pain that caused individual investors on the way up. But they did it to control inflation. They told you it was going to have some pain in the labor market. But the best news about that is there was no recession in 2022 when everybody was calling for one. There was no recession in 2023 when everybody going into 2023 was calling for that. We didn't. And we provided a ton of historical data as to why 2023 was ripe for a double-digit performing type of year. We came into this year with a very similar historical lens, and we've been correct on that. It's just not fun when you're seeing the market be in the red every single day. But instead of complaining about it, instead of treating the market like a casino, I'm giving you real life information about how to think and act so that you can control your emotions. You can, therefore, over time, have some predictability of your performance. Because again, the market is made up of human beings. Human beings are the most predictable thing on the planet. Therefore, over time, the market itself is very predictable. I know regulators might not like to hear that, but the reason why the market's up 77% of the time on any random year on January 1st when you wake up is because corporate America is charged with increasing their profits. That's why they have quarterly earnings.
Right.
That's why they do this. They're not in business to play nice or have some friends. They're there to make money. That's why the market is in general higher than it is over time. Okay. So if you're trying to get some grip on this hysteria that you're seeing in the market, trust me when I say it sucks, but there are some excellent historical fundamental reasons right now why you would want to be invested. And if you're not invested, you should consider getting invested. Maybe not all in one day, dollar cost averaging over time. So that was pretty much everything that I wanted to have a conversation with everyone about today. Very light from a data perspective. The data has been, we called it correctly here at Shepherd Wolf Management. And that is, unfortunately for me, talking about my emotions, that is the most painful thing, is to call the data correctly, but the market's response to that data is not exactly what we were looking for. It's kind of the opposite of what we thought may happen. So there isn't a good reason why there's $6 trillion sitting in cash. There is not a good reason why NVIDIA sold off more than 10% after a mic drop earnings. There's not a lot of good reasons for anything, to be quite honest, of what you're seeing here on a short-term basis. But I would be willing to bet a McDonald's coffee, because I am not a gambler by any means. For anybody that wants to take me on, that we will see 3 rate cuts this year. They're very likely to be 25 basis points a pop. You're not going to see a recession, and everything will be higher, meaning that the S&P will hit a new all-time high. We've hit several of them along the way this year, but you'll see the S&P, the NASDAQ, small caps, and even the Dow higher than what it is here today. Bet a cup of coffee on that for you, as I know that you won't take the other side of that bet, but somebody else out there will. And
Well,
I
I just
actually have
think you're
had.
going to be right, so I'm on your side.
Well, you wouldn't believe it, but truthfully, there are certain people in my life that will take the other side of a lot of those statements that I make. And I've collected a lot of coffees. I collected a lot of, actually, some people owe me some dinners. I'm going to collect on all this stuff. I'm keeping receipts. I
You
am
should.
collecting before the end of the year. And if I'm wrong, then I will gladly admit that I'm wrong. And dinners, I guess, on me, or coffee, or whatever the case may be. So this has been not a fun period of time. It
No.
feels better just talking through it.
Mm-hmm.
Part of the reason why I love doing this show is it kind of helps me put all my thoughts into some perspective for viewers, because there's a lot going on in between my ears, and I'm responsible for quite a lot. But I want to be able to give it to you guys in a very just raw, right after we get the data, right after the market reacts to that data, kind of what I'm seeing and how I would go about tackling this. And I hope it's helpful. I believe that if you take this advice, you'll be pretty happy with it by the time you get to the end of the year, going into next year. But we'll continue to do this every couple of weeks, roughly.
Yeah.
We'll be
every
doing this
couple
show. And if you haven't subscribed to it, please do. Share it with a friend, family member, coworker, anybody that's highly emotional. This will probably be helpful for them. And we'd love to get your questions too. So please send them our way.
Yeah.
Is anything that we need to leave these viewers with before we part ways?
No, just maybe the obligatory reminder that if you're catching this after the live date, whether it's an episode on YouTube or you see a clip on various social medias, or you're on Spotify, just head over to the shepherdwm.com website, or leave a comment on whatever quote or YouTube video you're looking at, and Joshua will get back to you. Even if you just have general finance questions, or, how did you arrive to this kind of, mindset, we'll address those in future podcasts. So please hit us with your
Absolutely.
questions. We love it.
It's been great. I hope you guys have a great rest of your Friday. Have a great weekend. Enjoy some football, college and professional. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Wishing you all a very happy Friday, and we'll see you in a couple of weeks. Take care.